This video is sponsored by OnePayLimited.com. OnePay Limited is a company that operates and invests in oil assets and cryptocurrency that generates solid returns for investors. With 5 solid investment plans, one can generate massive profit and attain financial freedom. For more information, visit App.Onepay.com. Learn about Forex, why to trade FX over stocks, and how to read currency pairs, for a complete introduction to Forex trading for beginners. We suggest you take a notebook and a pen because here at Trading Lectures we release you how to trading in real class standards. The size and depth of the Forex market make it an ideal trading market. Its liquidity makes it easy for traders to sell and buy currencies without delay. This creates tight spreads for favorable quotes. Low costs, large scope to various markets and flexible trading times make it the most frequently traded market in the world. How big is the Forex market and how much is it worth? According to the Bank for International Settlements Triennial Report of 2016, the foreign exchange market cap averaged $5.1 trillion per day. This figure is down from the previous report in 2013 of $5.4 trillion. There are only a few countries that account for the majority of Forex trading turnover. The graph below depicts the major global trading desks as a percentage of total average turnover. From a trader's perspective, large Forex market capitalization lends to less volatility as large trades do not have a significant impact on the price of the market. Smaller markets can be influenced by large institutions, traders with relative ease. However, within the Forex market this impact is comparatively diluted. Forex trading volume traders from other markets are attracted to Forex because of its extremely high level of liquidity. Liquidity is important as it allows traders to get in and out of a position with ease 24 hours a day, 5.5 days a week. It allows large trading volumes to enter and exit the market without the large fluctuations in price that would happen in less liquid market. This means that if you will never get in a position because of the lack of a buyer. This liquidity can vary from one trading session to another and one currency pair to another as well. As the most traded currency pairs, EUR, USD and USD, JPY account for approximately 41% of all Forex trades annually. This is an astounding percentage considering the scale of the overall Forex market size. Another surprising fact is that most of the pairs reflective in the diagram below are USD crosses. The US dollar makes up 85% of Forex trading volume. At nearly 40% of trading volume, the euro is ahead of the third-place Japanese yen that takes almost 20%. With volume concentrated mainly in the US dollar, euro and yen, Forex traders can focus their attention on just a handful of major pairs. In addition, the greater liquidity found in the Forex market is conducive to long, well-defined trends that respond well to technical analysis and charting methods. How to take advantage of the Forex market. As a trader, you need to capitalize on the advantages that come with the sheer size and volume of the Forex market. Need to consider what method or combination of analysis suits their trading style. At a foundational level, traders need to understand the following pillars to Forex trading. 1. Fundamental analysis. Since currencies trade in a market, you can look at supply and demand. This is called fundamental analysis. Interest rates, economic growth, employment, inflation, and political risk are all factors that can affect supply and demand for currencies. 2. Technical analysis. Price charts tell many stories and most Forex traders depend on them in making their trading decisions. Charts can point out trends and important price points where traders can enter or exit the market, if you know how to read them. 3. Money management, an essential part of trading. All traders need to know how to measure their potential risks and rewards and use this to judge entries, exits, and trade size. Forex traders employ these pillars in varying forms to craft a strategy they feel comfortable with. Once they find a balance between these central systems, they will turn their attention to specializing and honing their skills by keeping up to date with politics, monetary, fiscal policies, etc. and making informed decisions based on the information at hand. A technical trader may utilize various indicators, drawings and place trades resulting from these technical signals. Client sentiment can also give Forex traders an inside scoop as to potential reversals, market entry and exit points. Join our weekly Trading Sentiment webinar, or view our live IG Client Sentiment report for more information. What are Forex quotes? A Forex quote is the price of one currency in terms of another currency. These quotes always involve currency pairs because you are buying one currency by selling another. For example, the price of €1 may cost $1.1404 when viewing the EUR/USD currency pair. Brokers will typically quote 2 prices for any currency pair and receive the difference, spread, between the 2 prices, under normal market conditions. The following sections will expand on the different aspects of a Forex quote. The same quote will be used throughout this piece to keep the numbers consistent. Example of EUR/USD Forex quote. Understanding Forex quote basics. In order to read currency pairs correctly, traders should be aware of the following fundamentals of a Forex quote. 1. ISO code, the International Organization for Standardization, ISO, develop and publish international standards and have applied this to global currencies. This means each country's currency is abbreviated to 3 letters. For example, the euro is shortened to EUR and the US dollar to USD. 2. Base currency and variable currency. Forex quotes show 2 currencies, the base currency, which appears first, and the quote or variable currency, which appears last. The price of the first currency is always reflected in units of the second currency. Sticking with the earlier EUR/USD example, it is clear to see that 1 euro will cost $1.14 and 04 pips. This is unusual as you cannot physically hold fractions of 1 cent, but this is a common feature of the foreign exchange market. Bid and ask price. When trading Forex, a currency pair will always quote 2 different prices as shown. The bid/sell price is the price that traders can sell currency at, and the ask/buy price is the price that traders can buy currency at. This may seem confusing as it is only natural to think of bid in terms of buying, so just remember the bid/ask terminology is from the broker's perspective. Traders will always be looking to buy Forex when the price is low and sell when the price rises, or sell Forex in anticipation that the currency will depreciate and buy it back at a lower price in the future. Spreads. The price to buy a currency will typically be more than the price to sell the currency. This difference is called the spread and is where the broker earns money for executing the trade. Spreads tend to be tighter, less, for major currency pairs due to their high trading volume and liquidity. The EUR/USD is the most widely traded currency pair, so it is no surprise that the spread in this example is 0.6 pips. Direct versus indirect quotes. Quotes are often displayed in accordance with the home currency in mind, i.e., the country you reside in. A direct quote for traders in the US, looking to buy euros, will read EUR/USD and will be relevant to US citizens as the quote is in USD. This direct quote will provide US citizens with the price of 1 euro, in terms of their home currency, which is 1.1404. The indirect quote is essentially the inverse of the direct currency. 1 direct quote equals 0.8769. It shows the value of 1 unit of domestic currency in terms of foreign currency. Indirect quotes can be useful to convert foreign currency purchases abroad into domestic currency. What it means to buy and sell Forex. Buying and selling Forex pairs involves estimating the appreciation, depreciation in value of one currency against the other. This could involve fundamental or technical analysis as a foundation of the trade. Once a basis has been formed, the trader will look to other technical and fundamental aspects. Key levels of entry and exit will follow, keeping in mind risk management processes. Factors which affect currency pairs. 1. Political events. Government instability, corruption and changes in government can affect the value of a currency. For example, when President Donald Trump was elected, the dollar soared in value. 2. Economic policy. From a fundamental standpoint, Forex traders keep a close eye on unemployment figures, GDP, monetary and fiscal policies, just to name a few, which have influence over the value of currencies. Our economic calendar shows upcoming events which may shake up the financial markets. 3. Technical analysis. Technical traders tend to favor key price levels, support and resistance, trends and other indicators to form a basis for their Forex trades. How to buy and sell EUR/USD. Using the EUR/USD currency pair, we will provide an example of how and when to buy or sell Forex. Let's say you want to buy the EUR/USD. If the EUR goes up in value relative to the USD once the trade is sold, you could have made a profit, depending on commission and other fees. A trader in this example would be buying the EUR and selling the USD at the same time. As an example, if the EUR/USD pair was bought at 11,300 and the pair moved up to 11,504 at the time that the trade was closed, exited, the profit on the trade would have been 204 pips. This is shown in the chart below. In this example, the technical perspective was utilized. Asterisk entry level, Morningstar candlestick pattern shows a potential entry point, which was substantiated by the use of the RSI indicator, which displays an oversold signal. Exit level, using key price levels to set initial take profit level. Understanding risk management when buying and selling Forex. Risk management is essential to longevity in Forex trading. This does not simply include a positive risk-reward ratio, but understanding the potential swings in volatility as well. Factors affecting Forex pairs can have significant impacts at times, so preventing adverse effects on your trade can be managed by implementing proper risk management techniques. Buying and selling Forex can be complex, therefore understanding the mechanics behind it, such as how to read currency pairs, is essential prior to initiating a trade. We also recommend reading our Forex guide for beginners to get a crash course on the basics of Forex trading. Long versus short positions in Forex trading. Understanding the basics of going long or short in Forex is fundamental for all beginner traders. Taking a long or short position comes down to whether a trader thinks a currency will appreciate, go up, or depreciate, go down, relative to another currency. Simply put, when a trader thinks a currency will appreciate, they will go long the underlying currency, and when the trader expects the currency to depreciate, they will go short the underlying currency. What does it mean to have a long or short position in Forex? Having a long or short position in Forex means betting on a currency pair to either go up or go down in value. Going long or short is the most elemental aspect of engaging with the markets. When a trader goes long, he or she will have a positive investment balance in an asset, with the hope the asset will appreciate. When short, he or she will have a negative investment balance, with the hope the asset will depreciate so it can be bought back at a lower price in the future. What is a long position and when to trade it? A long position is an executed trade where the trader expects the underlying instrument to appreciate. For example, when a trader executes a buy order, they hold a long position in the underlying instrument they bought, i.e., USD, JPY. Here they are expecting the US dollar to appreciate against the Japanese yen. For example, a trader who has bought 2 lots of USD, JPY has a long position of 2 lots in USD, JPY. The underlying is the USD, JPY, the direction is long, and the size is 2 lots. What is a short position and when to trade it? A short position is essentially the opposite of a long position. When traders enter a short position, they expect the price of the underlying currency to depreciate, go down. Too short a currency means to sell the underlying currency in the hope that its price will go down in the future, allowing the trader to buy the same currency back at a later date but at a lower price. The difference between the higher selling price and the lower buying price is profit. To provide a practical example, if a trader shorts USD, JPY, they are selling USD to buy JPY. Traders look for sell signals to enter short positions. A common sell signal is when the price of the underlying currency reaches for level of resistance. A level of resistance is a price level that the underlying has struggled to break above. In the chart below, USD, JPY appreciates to 114.486 and struggles to appreciate further. This level becomes a resistance level and offers traders a sell signal when the price reaches for 114.486. What is a pip? Using pips in Forex trading. What are pips in Forex trading? A pip, which stands for point in percentage, is the unit of measure used by Forex traders to define the smallest change in value between two currencies. This is represented by a single-digit move in the 4th decimal place in a typical Forex quote. For example, if the price of EUR/USD moves from 1.1402 to 1.1403, this would be a 1 pip or point movement. Example of a pip using the quote to buy EUR/USD. However, not all Forex quotes are displayed in this way, with the Japanese yen being the notable exception. How to calculate the value of a pip? The pip value is calculated by multiplying 1 pip, 0.0001, by the specific lot contract size. For standard lots, this entails 100,000 units of the base currency, and for mini lots, this is 10,000 units. For example, looking at EUR/USD, a 1 pip movement in a standard contract is equal to $10, 0.0001 x 100,000. Being able to calculate the value of a single pip helps Forex traders put a monetary value to their take-profit targets and stop-loss levels. Instead of simply analyzing movements in pips, traders can determine how the value of their trading account, equity, will fluctuate as the currency market moves. It's so important to note that the value of 1 pip will differ for different currency pairs. This is because the value of 1 pip will always be shown in the currency of the quote, variable currency, and this will differ when trading different currency pairs. When trading EUR/USD, the value of 1 pip will be displayed in USD. When trading GBP/JPY, this will be in JPY. This video is sponsored by OnePayLimited.com.